What is Startup India? What is the eligibility, tax exemptions and incentives of startups in India? Prime Minister Narendra Modi proclaimed the Startup India campaign in 2016 to boost entrepreneurship in India. The action plan aimed at promoting bank financing for startups, simplifying the incorporation of the startup process, and grant of various tax exemptions and other benefits to startups. But all the benefits and exemptions are available to the startups only if they come under the criteria of an eligible startup. So first let's understand the conditions to be met to qualify as an eligible startup. Eligibility for Startup India. As per the Startup India Action Plan, the following conditions must be fulfilled in order to be eligible as startup. Has not yet completed a period of 10 years from the date of incorporation or registration. Is a private limited company or registered as a partnership firm or a limited liability partnership. Has an annual turnover not exceeding 100 crores rupees for any of the financial years since incorporation or registration. Is working towards innovation, development or improvement of products or processes or services, or if it is a scalable business model with a high potential of employment generation or wealth creation. It is not formed by splitting up or reconstructing a business already in existence. Tax exemptions allowed to eligible startups under Startup India program. Following tax exemptions have been allowed to eligible startups. 3-year tax holiday in a block of 7 years. The startup incorporated between 1st April 2016 till 31st March 2021 were eligible for this scheme. Budget 2022 has extended the eligibility to 31st March 2023. Such startups will be eligible for getting 100% tax rebate on profit for a period of 3 years in a block of 7 years provided that annual turnover does not exceed 25 crores rupees in any financial year. This will help the startups to meet their working capital requirements during their initial years of operation. Exemption from tax on long-term capital gains. A new Section 54EE has been inserted in the Income Tax Act for the eligible startups to exempt their tax on a long-term capital gain if such a long-term capital gain, or a part thereof, is invested in a fund notified by the central government within a period of 6 months from the date of transfer of the asset. The maximum amount that can be invested in the long-term specified asset is 50 lakh rupees. Such amount shall be remain invested in the specified fund for a period of 3 years. If withdrawn before 3 years, then the exemption will be revoked in the year in which money is withdrawn. Tax exemption on investments above the fair market value. The government has exempted the tax being levied on investments above the fair market value in eligible startups. Such investments include investments made by resident angel investors, family or funds which are not registered as venture capital funds. Also, the investments made by incubators above fair market value is exempt. Tax exemption to individual or HUF on investment of long-term capital gain in equity shares of eligible startups under Section 54GB. The existing provisions under Section 54GB allows the exemption from tax on long-term capital gains on the sale of a residential property if such gains are invested in the small or medium enterprises as defined under the Micro, Small and Medium Enterprises Act, 2006. But now this section has been amended to include exemption on capital gains invested in eligible startups also. Thus, if an individual or HUF sells a residential property and invests the capital gains to subscribe the 50% or more equity shares of the eligible startups, then tax on long-term capital will be exempt provided that such shares are not sold or transferred within 5 years from the date of its acquisition. The startups shall also use the amount invested to purchase assets and should not transfer asset purchased within 5 years from the date of its purchase. This exemption will boost the investment in eligible startups and will promote their growth and expansion. Set-off of carry-forward losses and capital gains allowed in case of a change in shareholding pattern. The carry forward of losses in respect of eligible startups is allowed if all the shareholders of such company who held shares carrying voting power on the last day of the year in which the loss was incurred continue to hold shares on the last day of the previous year in which such loss is to be carried forward. The restriction of holding of 51% of voting rights to be remaining unchanged under Section 79 has been relaxed in the case of eligible startups. Thank you for watching. Please subscribe this channel for regular updates.